The investing world held its breath. After decades at the helm, Warren Buffett announced he would step down as CEO of Berkshire Hathaway. Buffett, a legend in his own time, had become synonymous with Berkshire Hathaway. His successor, Greg Abel, a longtime Berkshire insider and head of the company's non-insurance businesses. Abel, a quiet but formidable figure, had long been seen as the heir apparent. Buffett, retaining his role as chairman, expressed full confidence in Abel. He emphasized Abel's understanding of Berkshire's culture and his commitment to long-term value creation. The announcement, made at Berkshire's annual shareholder meeting, was met with a mix of emotions. One thing was certain: the company and the investing world were entering a new era. Warren Buffett's journey with Berkshire Hathaway began in 1965. The company, then a struggling textile manufacturer, was a far cry from the behemoth it is today. Buffett, seeing value where others didn't, gradually acquired a controlling stake. He then transformed Berkshire into a diversified holding company with investments spanning insurance, energy, railroads, and consumer goods. Buffett's investment philosophy, deeply rooted in value investing principles, became legendary. He sought out undervalued companies with strong fundamentals and long-term growth potential. His approach, often described as simple yet profound, yielded extraordinary returns, making Berkshire Hathaway one of the most successful companies in history. Buffett's influence extended far beyond Berkshire's walls. He became a cultural icon, his annual shareholder letters eagerly awaited for their market insights and folksy wisdom. His philanthropy, epitomized by his pledge to donate the majority of his wealth, inspired countless others. The trade war with China cast a long shadow over the global economy during Buffett's later years at Berkshire's helm. Tariffs imposed on goods flowing between the two economic giants created uncertainty and disrupted supply chains. Buffett, a staunch advocate for free trade, expressed concerns about the escalating tensions. He acknowledged the complexities of the issue, recognizing the need to address unfair trade practices. However, he cautioned against protectionist measures, arguing that they ultimately harm consumers and stifle economic growth. Buffett's own companies, with their global reach, were not immune to the trade war's effects. Some, like Berkshire's manufacturing businesses, faced higher input costs due to tariffs on raw materials. Yet, Buffett remained optimistic, expressing confidence in the resilience of the American economy and the ability of businesses to adapt. He continued to advocate for dialogue and cooperation, urging leaders on both sides to find common ground. Berkshire Hathaway's cash hoard became the stuff of legends. Under Buffett's stewardship, the company amassed a war chest of over $100 billion, a testament to its disciplined approach and Buffett's unwavering belief in preparedness. This mountain of cash, while a source of fascination for analysts and investors, also drew criticism. Some argued that it reflected a lack of investment opportunities, a sign that Buffett was struggling to find value in an overheated market. Buffett, however, remained unfazed. He viewed the cash pile as a strategic asset, a source of strength and flexibility in uncertain times. He emphasized that he would rather hold cash than make poor investments, a testament to his patience and discipline. He was content to wait, to allow the market to come to him, knowing that Berkshire's cash position gave him the firepower to act decisively when the time was right. In a surprising move for a man known for his aversion to technology stocks, Warren Buffett embraced Apple. Berkshire Hathaway amassed a sizable stake in the tech giant, making it one of the company's largest holdings. This unexpected investment sparked curiosity and debate, with many wondering what had prompted the Oracle of Omaha to make such a significant bet on a sector he had long avoided. The answer lay in Buffett's evolving perspective and Apple's unique position. Buffett, always a student of business, recognized that Apple had transcended its identity as a mere technology company. He praised Tim Cook, Apple's CEO, for his leadership and vision. He admired Apple's strong fundamentals, its robust cash flow, and its commitment to innovation. Buffett's investment in Apple underscored his willingness to adapt and evolve. It served as a reminder that investing is not about dogma, but about identifying great businesses with enduring competitive advantages. Greg Abel, Warren Buffett's chosen successor, brought a wealth of experience and a steady hand to the role of CEO. A longtime Berkshire insider, Abel had risen through the ranks, leading the company's non-insurance businesses, which included a diverse portfolio of companies in energy, railroads, and utilities. His deep understanding of Berkshire's culture and his proven track record made him a natural choice to succeed Buffett. Abel, known for his operational expertise and his focus on long-term value creation, was cut from the same cloth as his predecessor. He shared Buffett's belief in decentralized management, empowering the leaders of Berkshire's various subsidiaries to run their businesses with autonomy. He emphasized the importance of integrity, capital allocation discipline, and a long-term perspective, values that had been central to Berkshire's success. His appointment signaled continuity rather than a radical departure. He was expected to maintain Berkshire's core principles while navigating the complexities of a rapidly changing world. Abel's leadership style, though less flamboyant than Buffett's, was no less effective. His appointment marked the beginning of a new chapter for Berkshire Hathaway, one that promised to be defined by steady growth, operational excellence, and a continued commitment to the principles that had made the company a global icon. Berkshire Hathaway's annual shareholder meeting, often dubbed Woodstock for capitalists, was more than just a corporate event. It was a pilgrimage for value investors from around the world, a chance to hear from the Oracle of Omaha himself and soak up his wisdom. The atmosphere was electric, a mix of excitement and reverence, as thousands of shareholders gathered to celebrate their shared belief in Buffett's investment philosophy. The meeting, held in Omaha, Nebraska, was a testament to Buffett's grounded nature. It was a far cry from the glitz and glamour of Wall Street, a reminder that true value lay not in hype, but in sound fundamentals and long-term thinking. Buffett and his longtime business partner, Charlie Munger, took center stage, answering shareholder questions for hours on end. Their responses, a mix of wit, wisdom, and insightful analysis, provided a masterclass in investing and life. They shared their thoughts on the markets, the economy, and the businesses they owned, offering a rare glimpse into their decision-making process. The meeting was a celebration of patience, discipline, and the enduring power of compounding. Even as Berkshire Hathaway thrived, a shadow loomed large over the U.S. economy, the national debt. The U.S. deficit, fueled by a combination of factors, including tax cuts and increased spending, continued to balloon, raising concerns about the long-term health of the economy. Buffett, known for his fiscal prudence, expressed concerns about the trajectory of the debt. He acknowledged the complexities of the issue, recognizing the need for government spending in areas such as infrastructure and education. However, he cautioned against unchecked spending, arguing that it could lead to inflation, higher interest rates, and ultimately, a drag on economic growth. He believed in the importance of fiscal responsibility, urging policymakers to make tough choices and find ways to balance the budget. Buffett's concerns were not driven by partisanship, but by a deep understanding of economic principles. He reminded policymakers and citizens alike that there were consequences to unchecked spending, and that addressing the deficit should be a priority. As Warren Buffett stepped down as CEO, the future of Berkshire Hathaway rested in the capable hands of Greg Abel. The company, built on a foundation of value investing, operational excellence, and a long-term perspective, was well-positioned to navigate the challenges and opportunities that lay ahead. Abel, with his deep understanding of Berkshire's culture and his proven track record, was uniquely qualified to lead the company into a new era. The transition, though significant, was expected to be seamless. Buffett's presence continued to be felt, his wisdom and guidance shaping the company's strategy. The core principles that had made Berkshire successful remained firmly in place, a testament to their enduring power. Abel would need to navigate these complexities while remaining true to Berkshire's core values. He would need to identify new opportunities for growth, deploy the company's vast resources effectively, and ensure that Berkshire remained a beacon of value creation for its shareholders. The legacy of Warren Buffett would endure, guiding Berkshire Hathaway as it continued its remarkable journey. Warren will always stay in our hearts. Stay tuned for more on this on our Value Investing channel. Happy investing!